Imagine the Fed cuts interest rates 3 times. Wall Street celebrates, but long-term Treasury yields barely move. That sounds impossible under the old playbook. Something inside the bond market has changed. The Fed still controls overnight money. What it may no longer control is the borrowing cost that matters most to markets. And the clearest warning is coming from something that used to protect investors when stocks crashed: Treasury bonds. For decades, the relationship was simple. When stocks sold off, investors rushed into government bonds. Treasury prices rose and yields fell. The bond side of a portfolio helped protect the stock side. That protection was incredibly valuable. But lately, it has become much less reliable. Since 2016, on days when the S&P 500 fell more than 1%, intermediate Treasury bonds had a correlation to stocks of roughly -0.2. In plain English, when stocks were hurting, bonds usually helped. This year, that correlation has been around +0.3. Stocks fall, and bonds can fall with them. That may sound like a small technical change. It isn't. Government bonds were never valuable simply because they paid interest. They were valuable because they acted like insurance. If that insurance becomes less reliable, investors start asking a different question. Why should I lock up my money for 10, 20, or 30 years unless I'm being paid more to do it? That extra compensation is where the term premium comes in. Forget the complicated terminology. The term premium is basically the extra return investors demand for taking the risks that come with owning a long-term bond. Inflation might come back. Government borrowing might surge. Interest rates might move against you. And unlike a short-term Treasury bill, you could be stuck holding that bond for decades. When long-term bonds stop providing reliable protection during market stress, investors have even less reason to accept a low yield. So they demand more, and that's only half the problem. At exactly the same time investors are becoming more cautious about long-term bonds, Washington needs them to buy enormous amounts of government debt. The United States is running large deficits. Those deficits have to be financed. And that means the Treasury must continuously sell debt to investors. Pension funds, insurance companies, banks, asset managers, and foreign buyers all play a role. Someone has to absorb all of that supply. And the more debt the government needs to sell, the more important one question becomes: what yield will convince investors to keep buying? Now put those two forces together. The United States needs investors to absorb more debt. But one of the biggest reasons investors historically wanted that debt, portfolio protection, has become less dependable. More supply, less valuable insurance. That means investors may demand higher compensation. And that is the structural pressure underneath long-term interest rates. This is where the Fed problem begins. The Federal Reserve can cut the federal funds rate by 25 basis points. It can cut again. It can even cut several times. But that does not force investors to accept a lower yield on a 10-year or 30-year Treasury. Imagine the Fed cuts rates by 50 basis points. At the same time, investors demand 50 basis points more compensation for inflation risk, fiscal risk, and holding long-duration bonds. The Fed eased, but the long-term yield barely moved. That matters far beyond the bond market. Long-term Treasury yields influence corporate financing, asset valuations, government borrowing costs, and the discount rate investors use across markets. So the Fed can ease while financial conditions remain tighter than expected. That is the contradiction most investors are not prepared for. Companies refinancing old debt may still face expensive borrowing costs. Investors waiting for a huge rally in long-duration bonds may not get the payoff they expect. Higher discount rates can also pressure valuations across stocks and other assets. And for Washington, the consequences are even more direct. Higher Treasury yields mean higher interest costs on government debt. Higher interest costs put more pressure on the federal budget. More pressure on the budget can contribute to larger financing needs. Larger financing needs mean more debt has to be sold, and more supply can require investors to demand still more yield. That's the feedback loop worth watching. It does not mean yields can only rise. A deep recession could still send investors rushing back into Treasuries. Inflation could fall sharply. Government borrowing could slow, and bonds could regain their role as reliable portfolio insurance. But that's exactly the point. If you're waiting for long-term rates to fall, the next Fed meeting is not enough. You need to watch what would actually change the bond market itself. Does inflation become less threatening? Does Treasury supply become easier for the market to absorb? And when stocks fall, do Treasuries start protecting portfolios again? Because until those things improve, the old assumption that Fed cuts automatically drag long-term yields lower may keep disappointing investors. The Fed has not lost control of interest rates. It still controls the front end of the market, but it may have much less influence over the long end than many investors assume. And that matters for everything priced off long-term yields, corporate debt, equity valuations, duration portfolios, and ultimately, the cost of financing America's debt. The next Fed meeting will dominate the headlines. Every inflation report will move markets. Every jobs number will change expectations. But underneath all of that is a slower and more important shift. America is asking investors to absorb more long-term debt at a time when that debt may be providing less protection inside their portfolios. And investors are responding in the simplest way possible. They're asking to be paid more. So the most important question may no longer be when the Fed will cut. It may be this: what would actually make investors want long-term bonds again? Because until that answer changes, the Fed can cut short-term rates, and long-term yields could stay painfully high. If you found this useful, hit like and subscribe to Global Notes by JP. Because the biggest market shifts usually happen underneath the headline, and that's exactly where we'll keep looking.